Hello. When Helm Godfrey's managing director asked me if I would speak about one of the more vexed political subjects of our generation, what I should have said was no, but instead I heard myself say yes, so here I am. But I'm really just going to focus on those risks associated with a hard Brexit. In that regard, I'm reasonably relaxed, but I'm not downplaying those risks. There are some serious risks there, but the categories of risks that concern me most are those that are unexpected, those that are lacking in precedent, and those which have the potential to cause financial markets to become dysfunctional. 2008 and even further back in 1929, those are two events of huge societal and economic importance. And the thing is that what made it worse was the markets were dysfunctional. Lots of policy mistakes made. Actually, 2008 was associated with fewer policy mistakes than 1929, but the real damage was allowed to go on for much longer, and did go on for much longer because markets were dysfunctional. They were an impediment to a vigorous recovery. So 2008, for example, because the markets became dysfunctional, that's where the word, the credit crunch comes from. That was the credit markets becoming dysfunctional. It took the UK economy, for example, more than 6 years to recover from that, and that's really because the markets were dysfunctional. So the risks that usually I focus on more often than not are those that have the potential to cause that level of market dysfunction. I don't think that Brexit, hard or soft, has the potential to do that. So when I say I'm relaxed about those risks, it's really, it's really inside of that envelope that I'm talking about. So really, it's a risk of whether or not UK assets perform strongly, whether they outperform or underperform in the forward period. But let me see if I can convince you of that also. Just a few observations to begin with. I'm going to start with Neil Ferguson's killer apps of prosperity. You may or may not have come across this, but this is his Neil Ferguson, the history guy, rather than Neil Ferguson, the virus guy. But this is his attempt to explain why Western economies in the last 200 years or so have been so successful in creating prosperity, particularly when compared with sort of non-Western economies. So the details are not too important for our purposes. What is important is if you just go through each of these categories, each of those conditions were apparent in the UK, entirely independent of our EU membership, so that they were apparent before our membership, and they will be apparent afterwards. So if we believe that Neil Ferguson's right, and that having these conditions in place are a precondition for prosperity, and if I'm right that these conditions will remain in place post our European Union membership, then we will still have those foundations upon which our prosperity is built. So membership of the EU or not is important, of course it is, but all things are relative. Another observation is I kind of think of the European Union membership as a sort of legislative regime, and a soft Brexit involves fewer changes in that environment, in that regime, and a hard Brexit involves more changes. But it's important to realise too that those changes won't affect the whole of the UK economy uniformly. So we have today some companies that are at a disadvantage because of our membership of the European Union. There are some companies that are at an advantage, and there are a whole load of companies that are unaffected by our membership of the European Union one way or the other. So Some companies will be disadvantaged from exiting the European Union, but it's also fair to say, I think, that some companies will flourish because of it. Okay, so the Brexit continuum, where are we? So it is a continuum for a start. So either we're going to get a comprehensive free trade agreement, so that's the FTA there, that's the comprehensive free trade agreement, which is what we've got. Membership of the European Union, it includes that free trade agreement, so that's what we had before. Or we can have no deal whatsoever, but it's a continuum, so those are not the choices. We can have somewhere, we could probably find some kind of agreement that is betwixt and between those two. But just focusing on the right-hand side, which is the risk of a no deal. Even in that instance, there's a no deal and then there's a no deal. So I've got a sort of managed no deal and an accidental no deal here. The thing about an accidental no deal, if you cast your mind back to the pre-COVID days and during the sort of the period of time when what some people have described as parliamentary paralysis, I guess there was a chance that we could have we could have crashed out of Europe because some deadline had elapsed, or we could have suddenly found ourselves outside of the European Union without a deal and completely undesigned. That would have been shocking. That would have likely led to the thing about that scenario is that policy responses would have been reactive. If you contrast that with a sort of managed deal that's well signaled and affords the opportunity for policymakers to engage in proactive policy making to try and cushion the ill effects of that deal. So that's what I'm sort of saying. Even on the hard Brexit side, there are two branches. But I don't know about you. I think you'll agree with me that the sort of accidental no deal has disappeared now. So certainly a managed no deal as a hard Brexit, so a managed hard Brexit is certainly better than an unmanaged hard Brexit. What makes the accidental no deal scenario so damaging is that nobody would expect it. But I think we can safely discount that. I mean, who would be shocked if we didn't get a deal at this moment in time? I don't think anybody would be shocked by that. It's actually reasonably realistic by most people's estimation. Certainly, most people that I talk to. It's also, I think that's where the markets are. I think the markets are factoring the likelihood of a no deal quite reasonably too. So, where are we? Are we closer to the free trade side, or are we closer to the managed no deal side? So I don't know is the answer to that question. But this is going to go right to the wire. So we've got a good few months of speculation yet. So I don't know where we are on the continuum, but what's important to try and ascertain is where the markets think we are on that continuum. And I think the pound's exchange rate is one of the more reliable indicators of market sentiment towards these negotiations. So if we begin a few days, so this is a couple of weeks before the EU referendum, and then you can see a big drop here. But this is where we are today. We're around about 30, so the pound is about 13% lower than it was in the weeks leading up to the referendum. Here's what I say. Here's sort of what I mean. So the risks that concern me are those that are not signalled and without precedent. So this was certainly it should have been signalled. We should have been more alive to the possibility that the referendum result would have come in favouring the Leave side, but nobody really expected that. So it did come as a shock to the markets. And then I don't know if you, my recollection of that sort of period in time was that we hadn't really got into the many different types of deal that we may or may not have. I think the markets were most focused on the fact that we had just decided to come out of the European Union. So the market sentiment was closer to a no deal type scenario than it was to a good deal scenario. And I'm I look at that and I think, well, okay, we didn't expect it back then. It came as a bit of a shock, but this this serves as a good dress rehearsal for what might happen if we got a sort of accidental no deal. But we've taken the accidental no deal off the table, so we've got a good precedent as a sort of model for risk for what might happen in the event of markets finding a hard deal difficult to swallow. And the thing about that was it wasn't a particularly bad period for investors at all. In fact, investors were surprised at how well portfolios did, generally speaking. I mean, one of the reasons for that is if you had overseas equities, and certainly almost all of our clients would have overseas holdings, they went up in value at the reciprocal of whatever the fall in sterling was. So if sterling fell 15% and you held US equities, for example, because those US equities are denominated in dollars, then they were up 15% from the perspective of a sterling investor. Also, safe assets did really well in those conditions of uncertainty. So it certainly wasn't a very bad period of time for UK investors, even considering the scale of the shock. Conservative landscape, I guess the next important part there is where the Conservatives won a sort of landslide victory. Actually, that removed an awful lot of political uncertainty. I mentioned it earlier, but the parliamentary paralysis was in play, and we could have had a hung parliament. We could potentially have had a sort of Marxist chancellor, or somebody who used to be a Marxist chancellor. I mean, these were risks that the market was pricing in, and you can see that the pound did very well owing to that Conservative majority, but still it didn't recover what it had already lost. So the market is still discounting the pound because of the uncertainty. And let's not forget that Boris's "Get Brexit Done" message sort of hammered that home. And then here, just further along, we have got a low associated with sterling's exchange rate that came during this was the really the point in time when the markets were really factoring in that COVID. So the risks associated with COVID were becoming most acute around about that time. So this low in sterling incorporates the risks of a hard Brexit, because those were still factored into the market, and it factors in the risks associated with COVID-19. And the UK economy wasn't particularly strong going into this pandemic, and the pandemic was hitting UK particularly hard as well. So I think that low for sterling is a reasonable indicator. I think if it incorporates the potential for hard Brexit and lots of other bad news. So let's try and bring that into some order, shall we? And the question we're asking is the market placed for complacency? So is the market underestimating the potential for a hard Brexit? So if we take here as our free trade agreement position, this is when we were in the European Union, had a free trade agreement, so that's where sterling was then. This is the low point. So this is that low point I've just mentioned associated with the pandemic. So that's a really pessimistic. The markets were very pessimistic during that period of time. Let's associate that with a managed no deal. And where are we now? So sterling's around about here, which puts us fairly close to the managed no deal end. So the pound is certainly not pricing in the potential for a really good outcome. It's in my view, it's priced towards the downside rather than the upside. We just have a look at what's going on in the betting markets, because financial instruments are sometimes very difficult to interpret because there are lots of influences, and of course, given where we are with the COVID. There are lots of other influences that are going on at the moment. But you can see that the betting markets here, their pricing a no at nearly 60%. So those people that are prepared to bet on the outcome, they interpret the likely outcome to be a no. So should investors be concerned? Yes, to some extent, of course. But when should we be really nervous? We should be really nervous when the risks, well, I'm most nervous when I perceive risks that are underrepresented in asset prices. So I don't want to buy risky assets that underappreciate the potential for some risk. And it seems to me that the realistic prospect of hard Brexit is reflected in the value of the pound, it's reflected in the betting markets, and it's also reflected in equity markets. So this is just a simple line chart of how world equities have done. I've taken it again to the 1st of June 2016, so a couple of weeks before the referendum. The red line is sort of the global markets, so you can see how well they've done since that period. And you can see that the blue line, which is UK equity markets, has underperformed the broader equity markets really quite significantly. Okay, the red markets are slightly flattered because they're all the US. I mean, if you buy the world equity market, you're basically buying about 2/3 of that is the US equity market. And about 1/5 of that is tech stocks, and both of those have done very well in the aftermath of COVID pandemic. So just to try and fix that and sort of take away that sort of flattering element, I've used a sort of equal weighted index again, which is a sort of global index, but sort of fixes some of those problems. But even there, you can see that the difference between UK equities and global equities more broadly is really quite large. So UK equities have underperformed global equities, and one of the reasons for that is that we've got this uncertainty attached surrounding the outcome of Brexit. That all makes good sense. Now, that is just how prices have performed. Some of the techniques that we use to try and figure out what might happen in the future, or more specifically, to answer the question, if we buy UK equities at this moment in time, do they have the potential to compensate us for the risks that are involved? My interpretation of that, and this is not an uncommon position to hold, in fact, it's reasonably consensus, certainly amongst UK investors, that UK equities offer really good value at today's prices, and they properly reflect the potential for risk that there is out there. So just a little bit of perspective. So here we are with my risk matrix. The future is uncertain. We never bet on a single outcome. We always consider what I call multiple scenarios. So many things can happen, and we work hard to limit the impact of any one particular event. So we're not taking the risks associated with Brexit lightly. And ordinarily, we'd be mindful that Brexit represents risks which have I'm going to call this a sort of high probability of manifesting in the first instance. So here you go. How likely is Brexit, a hard Brexit, as a risk? How likely is that to manifest? Well, I think it's very likely. And we've seen that my interpretation of both the currency markets, the equity markets, and the betting markets also is in accordance with that view. And the impact is, I've put it down as a moderate risk. Now, if the markets were underpricing the potential for it to happen, then I think the impact would be much bigger. But one of the reasons that the impact is only in the moderate band is because we have some risks that are more apparent that are much bigger. So COVID-19 is clearly a much bigger risk at this moment in time than Brexit does. Again, you know, Brexit will affect different parts of the economy to different extents, and you've definitely got some parts of the economy that will benefit from leaving the European Union, and some that won't benefit from it. Whereas COVID-19 affects the whole thing. You know, a general lockdown is a pretty harsh risk event. And just looking forward, the prospects for the UK economy to do well next year are almost exclusively dominated by our emergence from the pandemic, as opposed to whether we are in or out of the European Union. So hopefully that makes sense. It's a risk. We're alive to it. but it's a risk that's reasonably well signalled. We've got this sort of dress rehearsal for how it might affect markets. I don't think it has the potential to freeze up the UK financial markets. I think the Bank of England are on top of it and alive to it, and certainly if the financial system didn't freeze up over what happened earlier in the year, particularly around about that March low, when there was some real big risks associated with how the market was responding to COVID, then I'm reasonably relaxed about the potential for a hard Brexit, given that we are already in a reasonably strong position. If you know, with the scenario planning that we do, and our approach to risk management, I think we're reasonably well placed, come what may. Hopefully that's answered a few questions, but if you've got any more questions, I'm very happy to answer them if you just want to filter them through your financial advisor. Thanks very much.